Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So today is Monday, first day of the fourth quarter. Everyone came in with their guns blazing. All new money managers got their allocations of funds to start putting them to work. So futures were up, I think, 6-7 handles. We had an action area we were talking about. We were talking about 1449 to 1451 or 1447 to 1450, whatever it was. And we wound up pushing through it with that 10 o'clock ISM number. And then, slowly but surely, the market just faded, leading the way to the downside. Things you don't want to see, like tech, like the Russell, home, like a little faulty action in the home builders. So there was some things to kind of sniff out that that we weren't just going to go up, gap up, and do a gap and go. And even if you sniff it out, it's still hard to make some money and execute on it. Especially considering now it feels like the sentiment, everyone was talking about how the market could do no wrong, the Bernanke puts there, blah, blah, blah. So a few things that I've been noticing. One, guys who are in macro positions, they're doing just fine. We've been in a strong trend for over a year. That was reignited, so to speak, after we hit the low in June 4th. So at this particular point, the people who are not over trading they're just fine. They're just sitting back. They have their macro positions. They're putting their monthly money in. Okay. The intermediate trend traders, which is where I call my sweet spot, which, where I made the majority of my money this year, was when we were trending and holding the 8/21 day in the first quarter, or even the volatility from the second quarter with the head and shoulders top pattern where we were able to make money trading the indices long and short. And then really August into the September highs. That was like another accelerated time period where intermediate trend traders could buy high, sell higher, hold multiple positions. And then ever since that September 14th, second day after the Fed, we've been in this choppy pullback, digestion type of mode where for traders that try and buy high and sell higher, it's been hard. Even for guys that have been trying to make money tactically short, you've had maybe a short strength, and every time that we've looked lower, you've had to cover. Every time that we've opened down, you more or less had to cover into the weakness versus adding. So as a trader, it's hard, to make a lot of money when things look good, you want to add, and then they reverse to the upside if you're long in the same way. If you're short and you want to press, that hasn't been working. So recently, in the last week or two, I've been talking about how I'm going back to being a bit more tactical, going to try and day trade, even especially considering, Apple turned into a trade where it was trending higher and we were able to buy it 4 or 5 times to now it's actually an easier short ever since it broke the 21 day. So I'm going to break a few things down. Again, you have to know your time frame. You have to know how you approach the market, what you're looking at. The time frame could be this big, could be this big, could be this big, or it could be a micro scalp. But if you get caught in between those time frames, you're going to chew yourself up. So now, if you take a quick look, I'm going to take first a step back look at the chart of the S&P. I talk about patterns. I talk about repeating themselves. So just real quickly, remember last year? Remember this, head and shoulders formation when we broke the 1250 mark and you had that big move lower that consolidated down here. And then about a year ago, we had that outside day, October 4th. What I want to do is I want to show you, within this time period, okay, you had a fast and furious move. Okay, this is when we took out the downtrend, we hovered higher. We hit our high here, okay, which was about 1,300 from 1,100, 200 handles higher in a 4-week time period. And then if you kind of look there, it really didn't do much since. Okay, so I'm kind of I just want to make sure that this doesn't happen. Let me show you again. Okay, which was right here. I remember the 2 wedges that formed in here. We talked time frames. So after we hit this high, okay, which was in the end of actually October. What was the date of this? This was actually, October 27th. We had a nice wedge formation where everyone thought we had to head higher into the end of the year. And bear in mind, we had a nice healthy move in the market overall, but even before then. And then we actually broke down from this wedge. And I remember it broke down, everyone got really, really bearish, really bearish. And then if you remember, we took out the Fibonacci retracements and we looked to see what it held, and it held like the last one. The last Fibonacci retracement, the 0.618, where literally people almost abandoned the rally. Strong rallies hold the 25%, the 38, even the half. This one was about to be thrown out the window, and it held right there. So anyway, from there, okay, let's remove some of this. Let me get this out of the way so I get the noise out of the way. There really wasn't that much unbelievable or really great trading, throughout the course of November and December. They gave the big move from the lows all the way to the highs, before resetting up in this more macro wedge that wound up resolving, which we talked about a few times on CNBC, this and that, from the new year going into the first quarter, before we had another head and shoulders top type pattern, which we talk about patterns repeating themselves, where you could have got rid of some stock, got a little short, traded from a net short position, and then PS, a few, 100 handles or so lower. We had another outside day right there, which, changed the trend back to the upside. Okay, so if you look at what just transpired since the June 4th low, it's a hell of a move. Maybe not as exaggerating as quick as this one, but this has been a really nice move. Okay, we're up about 15, 16% in the S&P. We're up about 18% in the NASDAQ. So if you come to me, that right there is, if this was the end of the fourth quarter, I would say long equity funds would be high-fiving, saying what a great year. So now at this point, since a lot of expectations have been met, people are like, oh, well, we have to make new highs in the year or in the end of the year, which we might, but you really don't have to, considering the economy is still somewhat sluggish. And that's, I think, giving it the benefit of the doubt. You still have a slowdown in Europe that's trying to get fixed. It's going to take time, but at least they have the framework, and at least it's not doomsday convertibility risk like it was a year ago. So they're coming, they're slugging along, whatever, or slumping along. So for the S&P to be up like plus 20%, or even the NASDAQ to go plus 20-something percent after the year we saw last year, it's asking a lot. So at this point, I just want everyone to just bring down their expectations, because now that it's like a foregone conclusion that we have to close above 1,500 in the S&P. At this point now they're shaking the tree and a lot of people are getting chopped up. So now if you want to take a closer look, because we trade the intermediate closer trends to see how you could maneuver, you go to the chart and you'll see, today to me was not a good day. All right, a day where first of all, if you want to see here, this was that like cup and handle pattern. This was the breakout from the ECB. This was when Big Ben finally spoken. And believe me, a lot of people are saying, oh, people don't think QE is going to work. This wasn't a Big Ben QE rally. This rally started well before Big Ben came out and finally announced it. But anyway, so on a micro basis, this was the level that we were talking about. This is the level that we pushed through, where shorts got scared, rightly so. We pushed through this 1449-ish or 1450. Some people got to cover. All right, some people bought up here thinking maybe that's it. We're back ready to go through the highs, and then we failed. So it could be that we're reading into this too much, or meaning that it just needs time. You almost take this out of the way, and then you really have a more macro wedge being put in place. Like get rid of the little maneuverable lines. Like this is that 1449 when, remember, that's when I went to cash and got a little short the spiders for that day and a half move before the reversal on Yom Kippur. Or that wasn't Yom Kippur. It was right into Yom Kippur. It was the buy. This was that Thursday. So anyway, you have an upper wedge being put in place, which could take a bit more time. But at least you have two different trends here. You have one trend that comes up and goes to the 50-day. And if you look, the 50-day is right here. And healthy markets, hold their 50-day and sometimes even test their 100-day. And you want to talk retracements or commitment to this rally. Look at the low here from June 4th. You go to those Fibonacci retracements. Remember we talked about what happened last year and how it still was able to rally. It went all the way down to the 0.618%, which is 1346, which I'm not saying is going to happen, but that's right around the 200-day. You'd have people jumping out the windows, if we get that kind of move. But anyway, we would try to hold this 25% retracement, which is still considered so pent up, so strong, is still here, 1422. That's I don't know how many handles that is. This might be 20 handles below where we are now. And then you have the 0.382, which tests right around the last breakout, which is at 1395. And then here, still the 50-day is at 1413. So I just want to put things in perspective that this has been a hell of a move, and we have faulty activity here. So I just don't want you guys to be always guns blazing. There are times when you could buy high and sell higher. Like, there's a lot of good activity in this month of August here, or even, going into Big Ben. But now it's a lot more tactical. It's a lot more, if you're in position, stay tier one. Every time I look for momentum, it's hard to find. So there is a small chance that, if we start breaking below 1430-ish, you could see 1422 and maybe even the 50-day at 1413, and then all the bears are going to claim victory. But meanwhile, look at what they missed. But anyway, we're traders. We tactically can make money. We don't have to, the markets don't have to be on the highs of the year in order for us to be on the highs of our year. So with that said, we have to tactically maneuver. A lot of people are like, Red Dog, I can't believe you were short Apple. I'm not a permabull, guys. I trade the action. I think one of my best years was when the financial crisis meltdown, because things moved fast and you were able to see the relative weakness when things tried to bounce and you could move around. But anyway, I do like to have multiple positions in high five when things are going up. I'm more of an optimist, realist, but I can't control the market action. We're just a jockey, and we just have to make sure we ride things the way we're supposed to. But anyway, with that said, when Apple gave up the 21-day, okay, it's 6. Before I get into Apple, I want to talk about a few other things real quickly with the sectors. I want to show you the Qs. Qs, to me, it's not blaring, but you had this upper level break, right? And if you look at the potency of it, okay, pretty potent. Came right into support, that held. This is sideways support. And then if you look here, really, we were never able to take back half of what that potent day was. And this was the Qs leading us, lower versus the spiders. And to me, this is always more important. I know Apple's in there and it's, heavily weighted here, but, this is pretty big. And, there are some people saying that this could be the right shoulder. Okay, I have a head and shoulders pattern on the Qs, which could happen, which could be true. I'm not having bull glasses on. I'm just pointing things out. But here is your 2-day down move. Here's your bounce. Not much follow through. Here's your big time support going across, or what would be the neckline. You could even maybe draw it a little diagonal here, and we shall see what happens here. If this holds, okay, because sometimes necklines don't break. It could continue higher, but if it doesn't, from like 70 down to just say 68, even just say 2 points, and you're right back to here, 66, which would be that pattern. We'll see. We've got to see the way it works out. We just can't be blind to it. But all in all, I would say short term, this is definitely a bit more, worrisome versus constructive. This is when momentum left this upper area, and now we are hovering in the bottom end of what could be just say this new range. So just got to look at that, and look at the XHB, the home builders. They've been a great spot for us all year long. We talked about it so many times, and there are a lot of places to have bought it. When it broke out right here, when it added some fuel right here, and then if you look at this little trend right here, it broke the accelerated trend. So if you trade accelerated trends, that's when you get out of the way. If you remember when Lennar came out with numbers, I said it's probably priced in, let's sell it. I think it was a week ago Monday at the morning call. And whenever something comes out with good news and they sell it, here's your outside day, it's a little worrisome. If you missed it right there, could have been right there. Okay, now it's still hovering on a decent trend line. But again, here's like a lower wedge, not much of a bounce. So you just take out the name of the stock and you put in the chart, pretty potent move to the downside, going sideways, it could continue lower. And here's the 50-day. So if you go to the XHB, the home builders, you will see that here's your accelerated trend line that wound up breaking. So right there, is where you could have high-level stops if you were riding these home builders, if you trade intermediate trends. And now, it's in this lower range. Couldn't take back more than really a third of from here to there. And if it starts getting below 24.61, it could have another move down. Okay, to retest this prior breakout, and look where the 50-day is. It's all the way down here, so that could continue to move up. So you can see something right there. So just be a little careful. These are like some warning signs. The Qs, XHB, even the Russell, a little bit of a warning sign, right? Russell had its last move, played catch up. It broke this little last trend right there. Potent, couldn't take back more than half of it, and it too could see a move to the 50-day moving average, but still be fine. So these are just short-term little signals that if you trade the short-term intermediate trends, you have to look at, because it could happen, especially considering we're only in October and earnings season's probably not going to be great. So if you look here, this can continue. You look at some stocks that look like death, Caterpillar, not much of a bounce here, guys. Okay, a hole in the chart still, closed near the lows of this move. It could go lower. Guys are saying the same thing with Deere. Actually, Deere did an outside day type of action where it pushed through and closed. This is not as bad as Caterpillar. But anyway, now I'll go to Apple because people like to follow me trading Apple. And I've given a few different clues with Apple. First, when it broke 683, that's when you finally saw it leave my virtual trading floor as a long, which I've had there pretty much since, I don't know, 600, and then again it. I got to go to the chart. You know, if you go to the chart of Apple, you know, ever since this area, I've been pretty much net long Apple, you know, for the majority of the way up. Okay, and there it is. On this day right here is where I said, you know what? You had the gap down on the 5 million iPhones. If we break 683, it's going to be more of a trade for me. It's breaking the 21-day. We're rolling down. Could be in a little bit of trouble. Okay, so after, you know, a Bible strategy here, Bible strategy here, Bible strategy when it traded through 644, you know, you know, above 700 on this tiny little reversal was worth being lighter. Okay, and I was actually long, you know, over that weekend, and then I just salvaged it right there, which, you know, you could always salvage your trade. 683, you know, you could have ran for the hills, and, you know, PS, you're at 659 now, and you just saved yourself 24 points. So I know people say you have to invest in Apple, not trade it, but this is 24 points. And if you remember, we caught a nice little trade here on that red dog reversal when it went as high, you know, when it went through the 661.20 and came back up and closed near the highs. But look what happened the next day. Okay, that's something of very importance. Okay, look what happened here. It came back up, retested the 21-day, and got rejected. Now, another rule that we talk about, if you come back to me, Parker, is you could measure commitment by the day after a big move. If you have a big move and the stock holds the top third of the range, you know what? There's commitment to that move. It can even hold half of it, but then I'm like, you know, it's more of a trade if it doesn't hold at least half. So if you look at the day after on Friday, which we all came in long to see if there was going to be any follow through, look what Apple did. And if you remember, we tweeted right here, go back to the chart, okay, that if 676 doesn't hold, go back to the chart, you know, that you can get out of the way, okay? And not only did 676 not hold, look where it closed. It closed at 667, down another 10 points, showing you can maneuver it. This is when we said it could turn into more of a two-way trade, not just a long, which when it was trending and acting well, but more of a choppy short and maybe even, you know, a net short, because that's the way it's been trading. And then today, okay, we discussed 666.75, which was yesterday's low. And then also, you know, where the 21-day was coming into, which was around 675, 676. So if you know, for those of you that follow us on the VTF or on Twitter, you know, people like ask me, what should we do with Apple? And then first things first, I'm like, I don't think you should be adding at 675, 676. That's a big resistance spot. And if it's going to be any good today, you want to see commitment, it should hold above 672. Otherwise, it's just a trade. So, you know, PS, it hovered there, and then if you go to the chart pattern today, intraday, so you can see how you could have maneuvered, this was, you know, I thought there was like a really nice wedge type pattern right here, okay, where it wasn't sure. Okay, and I'll show you why I came up with 672. First of all, I don't just come up with numbers, okay? They all have a reason, all right? And if you look here, this is, you know, the downtrend from basically, you know, the two-day move or that whatever, that Friday move, and it broke above it early morning, you know, to then kind of, you know, with the high frequency guys traded through prior resistance. That's why I said 675, 676, and then it wedged here. This is a flag type pattern, okay? So as it got tighter, you had to be on lookout. It could have resolved to the upside, okay, which then meant that it held the 672 area, which would have showed commitment to this wide range bar and commitment to the break of this downtrend, but it didn't. Broke below it. So if you were trading it for a continuation, you know, this was your first, like, oh my goodness, I might get out of the way. And, you know, you could have got out at 672 because that was the level that we talked about. Or you could have even got short. You know, you could have got short right there because a lot of people did get short there. And then it wound up breaking to the downside. And then it wound up breaking, you know, it's the 666.75, which turned into another shortable area. So here is your quick reflex move into resistance. Then this was your wedge type pattern that wound up breaking to the downside. And then boom, and once we took out this 660, you know, this was on the price point sheet as a short, 666.75, and that's the reason why, is because you go back to your daily chart, and that was Friday's low. Again, 666.75. In order to get to this low here of 660.35, it has to get through Friday's low, all right, and that's what it did. So the reason why there was another price point at 660.35 is because it had to get through the low of the recent move in order to get down to test 656, which is the reason why we also, another level we talked about. If it gets through 660.35, that's the next level to look at. And then you have your 50-day here at 650.74, and then you have 644, which is the prior high. So right now, the guys were asking me, I think in the Q&A Stock Twits forum on Thursday, of the potential of a head and shoulders top, and I was like, you know what? If it bounces back up to 680s and gets rejected there, this could be the right shoulder. Okay, usually shoulders take a little bit longer to develop, but we'll see. And if that's the case, here's your neckline, and we're just kind of getting below it. So at this point, I think that I'm flat Apple overnight. Some people probably shorted, but I would say from here, from 700.05 to below 660, 45 points, it's a little dangerous to be shorted. But I think that it's probably the right trade the way it's trading right now. But I guess it is prone to some news also about iPhone 5s, whatever. So for me, I'm going to see how it handles 650.74 tomorrow. I'm going to see how it handles 644. Maybe it pierces through the 50-day, gets some stops out of people who have it at the 50-day, holds that. We get another type of red dog reversal, and then we'll see what kind of bounce we get. If it comes back and retests this 660, 662 area. But who knows? Maybe it opens up and you could short that for then a move through here to test that. So at this point, it's just a trade for us. It's not trending the way it did since the shortfall of earnings, which was right there. That was a nice trending trade. Now it's a two-way trade, both long and short, more to the downside than the upside. Anyway, we'll see what happens there tomorrow. As far as some pockets of strength, the banks with the Barron's article on Goldman, they held up okay. They held up a little bit better. So if you go to Goldman, it's off the highs, but still trying to hold in there. JP Morgan. You had to be really quick, and then it just wasn't ready for momentum. And we've been talking about how it's hard to find momentum in any of these things. But overall, JP Morgan is something that as an intermediate trade you could stay with, and macro-wise, it's doing fine off the lows. Visa and Mastercard, no bear market here. You could be a Visa equity investor and you're doing just fine. And this actually had a decent trade. It broke out, closed okay. So this is a bright spot, another bright spot. Mastercard looking really good. Look at this. Broke this area here, beelined all the way up. Since then, let the 21-day catch up, and it's trying to break out, so this still is okay. Google still has pent-up momentum. Couldn't really get through 764-ish. It tried, but again, with Apple so weak and tech so weak, it's hard for Google just to continue. But again, 747 was our target, way back here, and all of a sudden we're at 761, so it's been quite a run. Still following the 8, still following the 21. This was your entry right here, 625, and then when it took out the year highs, we talk about how when stocks take out highs of the year, they typically go a lot higher, and even if you missed this part of the move to resistance, there was still another nice move thereafter. Remember this 713, remember the retest of the 21-day, lots of great trades there. And then there are some other weak spots too, like the semis have been weak. The SMHs have been a problem spot, but the whole PC sector as a whole is just not the place to be. It's all handheld. So your SMHs, which are the guts of a lot of the PCs, besides ones that deal with just handheld, have been very weak. This is below the moving averages. This has been weaker. We talked about, remember Intel when they pre-announced? It was really weak anyway. Intel has not been a place to be. Remember this breakout failure right here? And then you have a low, a lower high. Then remember this move right here? It broke below support and then couldn't get back above. It turned into resistance and then it continued. So below all the moving averages is just something you don't want to be in. You look at Dell, it's like gross. Dell, my goodness, 979. We talk about what you could see here. Look at this gap. Here's your gap from earnings. Never even attempted to fill it. Okay, look at this hole here. And then it's just been a disaster all the way down. HBQ, disaster. This whole year. So there's definitely some spots that just you don't want to even be near, but then you have to be, in situations that make sense, that show relative strength, that don't pull in when the market's pulling in, that show technical strength. It's highly rated. IBD has a lot of them also. And those are the ones you stay with. Okay, so you just don't want to go after names because they did something good back in the day. We've been trying to keep everyone away from this rim from a hell of a lot higher, This thing, people didn't understand when it was just trending lower and trending lower. But meanwhile, look at this gap down. Never got filled, continued. This gap down actually got filled, but, and then wound up going lower. And then this was, I guess, a little bit more clear cut. We talk about gaps and the direction. look at this one, gap down, never even attempted to fill, continued. So there was a lot of different ways, to see RIM coming besides knowing that, there's just there's this new trend, and the trend was no one's going back to the BlackBerry. I know they're on BlackBerry 10, but anyway. So with all that said, there are some pockets of strength, and they're getting a little bit smaller, these pockets. And so at that point, when I see things get a little faulty, I pull back. There's only a few times a year where you could really buy high, sell high, or you could hold multiple positions if you're an intermediate trend trader, and enjoy a market move. Unless you're a macro investor, which if you saw the charts from October 4th, you had nothing really to worry about. If you go even to the monthly chart since the low in 2007, you really, have been higher low, higher low, higher low. And even for the decade, if you had a plan of buying S&P funds for the last decade, your probably cost averages is lower. And who knows, if we do get S&P 1700 by 2015, which I've been saying multiple times, you'll get even paid on that. But equities are far from dead. It's just a matter of how you approach it. It's what you want to get out of it. It's a time frame you look at things. And that's why we have an active trader course. We have a momentum trader course, and we have a swing trader course, because everyone approaches things with different tactics. So with that said, I don't like the fact that new money came in today and they weren't able to sustain the move. Maybe it's a trick, maybe it's not. But at this point, I'm going to be tactical. I'm just going to try and make money long and short, have lowered expectations. I'm going to have a plan every day. And then once we get a little bit more clarity, then perhaps we could put more, share size, more tier size on and make more from the market. There are times when you want to just make a little, and times when you could swing the bat, for a little bit of a deeper shot. For this time, just look for some singles. A bunt's not so bad either every now and then. And don't get frustrated, because you could definitely, be right and lose. I remember, if you guys were on the radio, I was shorting a lot of 662s in Apple, and then 660s. It went down to 650, 650, and didn't make as much at all of what I should have in that move, because I had too much, and I'm an uncomfortable short in Apple. I'm a more comfortable long, so I know myself. I just should take less and give it more space, and if I would have done that, could have made a lot more money. Guys are also asking about gold and silver. Hi, I'm Scott Redler, Chief Strategic. Just all right, back. Anyway, look at this level of resistance that it's trading against here. This morning it pushed through, okay, and then kind of failed, but I guess you can't really say it's not so drastic, not so severe, and that's the one caveat also, is like you look at the move a lot of these things have had into major resistance areas. Sometimes it might not be a long, because it's hard to get through, but if you try and overtrade and overhedge it and overshort it, you could be taking away some of the gains you made during this move. So at this point, still above the 8, still above the 21, and gold and silver are still hanging around. You want to look very, 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 very close, which is sometimes what we do a lot. Here you go. I guess you could say a small technical, faulty signal, but again, above the 8-day, above the 21-day, on an intermediate macro sense, there's really nothing to not like here, especially ever since August 20th. So I'm just talking, and sometimes that happens. So if you're watching, I apologize, or you could just deal with it. Hopefully you got something out of it. Again, time frame analysis is important, because everyone trades on different time frames. You could be a macro investor in Apple, own it 300 points ago, and not care about a 30 to 50 point move lower, or you could be a trader that bought it last week. You can't hold through the noise, and you capitulated out today at 660 because you didn't get stopped out at 683. So you have to figure out where you fall within that time frame, and that goes for all sectors. So once again, Scott Redler, T3 Live, the recaps here at the morning call with Brittany. Have a good night. Hi, I'm Scott Redler, Chief Strategic Officer for T3 Live, and I would like to invite you to join us on October 6th and 7th in New York City for our first annual T3 Live Active Trader Super Conference. The 2-day event will focus on what we believe to be the 5 keys to being a successful trader. We will teach you the strategies, tactics, and mindset we take to the market every single day, and you will leave the Super Conference with a personal step-by-step success blueprint. Visit t3live.com and click on the education tab on the top of the page and watch preview videos of this event. Seats will fill up quickly, so be sure to reserve yours today. My colleagues and I look forward to meeting you. Have a great day.